today.
It's good to be here. I'm glad we finally made it happen.
Yeah, I am good about it. For anybody tuning in, this is the first episode of the Real Estate Nerds. For today, we're geeking out on some deals with Scott Sutherland. He's a real estate agent and real estate investor extraordinaire here in the Austin area. If it's your first time joining us, buckle up. We cut the fluff and we're only getting into the nit and gritty of the hard hitting facts of deals, right? So we're looking at what are the operating agreements? What are the numbers? For anything else, go to Robert Kiyosaki. Look at those guys. If you're looking at high level, 10,000 feet up, stuff to put you to sleep at night. We're going to be getting into what you really need to know whether a deal's good or not. So just to kick things off here, Scott, would you just share with us a little bit about, how you got into real estate and what made you fall in love with it and start doing it?
Sure. Yeah, absolutely. So I've been full-time in real estate now for about 8 years. And for me, it all came together when I was a product of the stock market back in the late 90s, kind of the pre-dot-com, what many people refer to as a lost generation of stock investing. We had a few good years, but overall we had a kind of a flat decade. And I followed along with Motley Fool and some of the other investing strategists in the stock market. And we were all trying, we were all chasing some of the stock high flyers and the dot-coms of the era and trying to make our fortune on the stock market. And most of us did not succeed in those endeavors. But what I did learn from the Motley Fool was the power of compound interest. And that if you could figure out a way to consistently return, double digits annually, that you would be quite wealthy in a short amount of time. Yeah. So having failed to do that in the stock market, it kind of faded into my memory. And then one day I come back from a long vacation, a little bit of a sabbatical time period back in 2008 when the stock market was at its worst and I was looking for my next venture. And I started analyzing real estate returns in the Austin market, looking at rental rates and purchase prices and cash flow ROI. And I was shocked to see that the ROIs for some of the investments were, 25, 35% on a levered basis. So it kind of pulled me back into my memory of the Motley Fool and all the compounding.
Too good, true, right?
Well, and honestly, that was my initial reaction. I thought, this can't be right. I sent it out to a bunch of people and I said, am I doing this correctly? And they said, yeah, those numbers look correct. And shockingly, in spite of the fact that these numbers were so good, everyone was afraid to invest. And this kind of goes back to the Buffettism of be brave when everyone else is scared and be scared when everyone else is brave. So we decided to be brave in a down market, and that was back in 2009 and 10, and it really kicked things off for us. That was kind of the impetus for my foray into real estate back in that period, and still doing it today.
So is everybody brave or scared right now?
I would say that everyone is brave right now, which is terrifying.
Yeah.
Yes.
And you see like 30% return. Somebody's shooting a deal where he says, I can get you a 30% return on this.
Those returns are long gone. The market today requires far more creativity. And honestly, there are times when you have to sit on the sidelines and just hoard cash and wait for your moment. In my opinion, it's much better to have nothing to do than be tied up in a bunch of unprofitable projects.
Yeah. So. Well, for sure, right? Because then you're ready to act, right?
Right.
You're ready to say, like, I'm waiting until the time is right for me to get in instead of trying to say, I'm going to force a deal into it. And like what I see is, I'm a real estate investor and asset protection attorney. And the pieces of what I see time and time again is, you see guys that'll pitch off deals that are 30%, and I say, fantastic, great. Well, actually, let's see what the deal actually is. And how much of that is, really what the basis of this show is about is saying, cool, awesome. I'm not going to say that just because somebody says it's 30%, that is BS.
Right.
I want to see the actual deal and show me where the numbers are coming out and what are projections and what are the projections actually based off of.
Right.
Because, projections can be pretty much anything. Some are good, some are bad, right? So how do we actually look into that?
Right.
And overall, what's an investment strategy that makes sense to not just a small handful of people, but actual real professionals like attorneys, CPAs, and professional investors that would all look at that and say, that's great.
Right.
That actually looks like a real deal.
Right.
And not look like one that's just somebody trying to scalp money off of an investor, right?
Absolutely. And at the end of the day, you've got to search for the best of what's out there and then determine if that is good enough for you or whether you'd rather preserve your time and preserve your capital for a future opportunity.
Yeah. Well, one of the reasons why I wanted to sit with you here today is because I wanted to learn more about how is it that you're thinking differently about, because it's because if the case was that everybody looking at deals when you were all could see 30% returns, everybody would have been doing those deals. Because nobody in their right mind doesn't take an asset-backed security and invest at a 30% return. All right?
Right.
Yeah. So how is it that you're, and looking through that, what is it that you think like has you thinking differently that's been effective in your investing?
I remember at the same year that and my wife is also a real estate agent, and it just so happens that the year that we started we started dating in 2008 and got married in 2010. So along with starting this new real estate business, I was also starting a relationship, and today she's, my business partner, my life partner. So she and I had a lot of conversations about whether or not we thought we were right or not. And just kind of checking each other to make sure we weren't, jumping into something, why is everyone else not doing this if it's such a brilliant idea? So you tend to, there's that herd mentality. I know everyone feels better doing what everybody else is doing, but it doesn't always result in the best outcomes. So her question, so at the time we were buying duplexes in Austin for $85,000 a duplex. The same duplexes had been worth twice that a couple years prior. So they were on the decline, and you'll hear people say never try and catch a falling knife. Right. And so that was the question is, are we trying to catch a falling knife? And the way my wife phrased it is, I said, these are worth 160 and now we can buy them for 80. And she said, well, what if they keep going down? And my response was that I don't care if someone says they're worth zero, because the cash flow is the cash flow, and it's based upon what you have into the asset. And we were going to achieve 30% returns on our input. And the only thing that could change that is if we had a reversion in rental rates. And there's no, at least in our market, there's been no historic reversion of rental rates as far back as we have records. So we just felt that we would just hold them forever. It just seemed like a good bet, regardless of what value other people placed on them.
Yeah. Well, to me, what that sounds like too is like it's your worst case scenario.
Right.
Like if my worst case scenario is that I have a hold on to this asset and I have a 30 cap return on it, fine. I'll do that all day. Right. I don't care. Right? That's super smart, especially in investment psychology. We always tend to look at as saying we are coming up against something that there's a high level of fear, right? Which is going to happen to all of us in times of our lives anytime we're making a big decision. It becomes exceptionally more difficult if everybody else is all sharing the fear at the same time. Because now if you say you're different, you're arrogant. But you might be arrogant in the right way, right? Like that comes from the same well, right?
Right.
And I think a lot of times for my personal life as a, entrepreneur in a few different businesses and doing really wild stuff. Like I bought my first investment property while I was in law school and running a transmission auto repair while I'm going to law school and working for the district attorney, right? All of those are crazy, right? But the difference is saying like everybody else was too afraid, but I could say, well, my worst case scenario is X.
Right.
And I'm okay with that.
Right. And
that's really what it is. And then if I'm wrong, it's very recoverable to get back on track. But if I'm right, I graduated from law school with no debt. And that puts me way ahead of everybody else. So it's minimum risk if you know what your maximum downside risk is. So I just wanted to underscore that as a piece to say like that is the difference in my experience between people that are successful and not successful. Is that they're willing to take risks, but they understand that they're okay being wrong, but they know how wrong they can be. And in your case, It was almost like a no-brainer.
Right.
My wrong is that I'm fabulously wealthy.
Right.
But just in a different way.
Wrong is still very good.
Yeah.
Very good outcome. Right. And we look at investment property. We always try and have a plan A, B, and C. And we'll say, well, we try and go down every what we consider likely negative scenario and then have a contingency plan. And then once we're comfortable with all those scenarios and our response to them and the probability of each, then we jump in.
Yeah.
And then if you can also mitigate some of those risks through various types of diversification, whether it's, multiple properties, multiple markets, being, stock versus real estate diversification. So,
cool.
So we try and keep things in multiple areas. That being said, I also am a firm believer that you should have all your eggs in one basket. From a standpoint of the more you know about a given business, the more effective you can be in it. So it's great to diversify within assets, but I also believe in sticking with what you're good at and what you're experienced with and being very cautious as you move into areas where there's a high level of variability from your experience.
Yeah. I tend to agree with you. I mean, you should do what you're good at. That's where you're going to have the highest returns is where you're putting in your own brains into something to figure out stuff better than other people. Mm-hmm. And one of the things that I know that you do really well is with your Airbnb rental type of business, right? Because even in that market, if you say, well, Scott's actually too concentrated inside of what he has owning for real estate. Wait, is that really true? Because not all these real estate pieces are really the same. Like a vacation rental can be based off of saying what's my cash flows associated with that. And that's actually dependent upon tourism, which we know is really strong. And then I have other rental income that's here that's really facilitating, whatever type of class of income earner. And maybe that's really strong unless a bunch of people die. And if a huge amount of people die, we probably have other problems.
Right.
So I'm not really too worried about like that end up coming to be the case, right?
Right.
So like even inside of an asset class, right, they're not all made equal. What we would probably need to test, I'm just kind of spitballing here, is that what you want to test inside of that is saying, like, what are my assumptions that would make this asset actually fail to perform, right? Like, if a bunch of people died, all of my rentals might go down. But then all of a sudden, probably all real estate prices are probably going down too. So you're just not going to invest in real estate because of all that? Okay, probably not, right? So like what are the indicators that we would know for like, let's just say like something that'd be like rental income? Where would you see like markets shifting or other things besides real estate prices that would indicate to you, hey, I should be really starting to get worried about
Sure.
Airbnb?
Well, a great example would be, so our biggest annual, and I'll use Airbnb and short-term rental synonymous. I think a lot of people just say Airbnb now. It's kind of like a bed and breakfast. It's an air bed and breakfast, right?
Yeah.
So South by Southwest is the largest single event for Airbnb in Austin and has been as long as I've been doing it. This last year, we actually saw a significant softening in demand during South by Southwest for the first time in a very long time. And I believe the reason for that is that the commercial construction, large-scale commercial construction like hotels, is a longer lead time process. By the time you permit and build a hotel, it can be 2, 3, 4 years to get it on the ground and operating. So for a long time, the smaller, more nimble movers like myself and the other Airbnb owners were taking advantage of that. But no window of large profits exists for any extended period of time because people will move in to absorb it. So that's what we're seeing now is that the construction is, catching up on a lot of the hotels. Some of the apartments are starting to actually bring vacation rentals into their portfolio. So they'll have, 90% of their units will be traditional apartment units and the other 10% may be, furnished almost like a hotel. So they might be operating 10% like a hotel Airbnb, 90% like an apartment. So we're seeing those rates come down. And I think the biggest risk is to people who are buying Airbnb assets at current market prices based upon historic rental projections. If those soften, if you bought a duplex 5 years ago for $200,000 and it's worth $800,000 today, you really don't have a lot to worry about. You have almost no debt, you have very little overhead, and even you can absorb a reduction in income. But if, however, you buy one today at $800,000 and the hotels continue to expand and they absorb that demand and rates drop, you don't have a lot of room to absorb a reduction in income. So that's why it's really hard to buy property right now, and it makes my job challenging, not just for my own portfolio, but for the clients that I represent. They come to me and say, hey, what's the best way to cash flow in the Austin market today? It's, I get that question a lot. And I will say that it's harder now than it's ever been. It requires even more creativity than it ever has.
Well, it's also like just knowing what I know about you. Like, aren't you involved in other pieces that you've pivoted off to? Like knowing that to be like with larger, I think you're doing some work out in Houston, right?
Absolutely. Yeah. We're doing some new construction. We're doing some rehab work where we do long-term rental, short-term rental. We go where the money is and where the opportunity is, and it changes. We're starting to expand into some secondary markets on the fringe of Austin that have the cash flow, a little better cash flow metrics than what we're seeing in the city. I always refer to the cash flow as the bird in the hand and the appreciation as the two in the bush, and I would prefer the cash flow over the appreciation because it's far more predictable. So we're starting to kind of expand out into some of those markets that have a little higher cash flow metrics and possibly at the expense of future appreciation.
And so, the one thing we just talked about before was saying like you should stick where your expertise is, right?
Right.
So, but typically we're only acquiring one expertise at a time with whatever asset we're interacting with, right? Mm-hmm. But now we just heard you say And we're actually in a bunch of different types of things.
Right.
Right?
Right.
So is your path into that saying, I'm going to get really good at one thing, then I'm going to add one more type of asset class where maybe have friends, family, or other people I know and respect that are in it, and then learn that one, and then is that the way you're stacking skill sets?
Absolutely, yeah.
Over time?
I'll refer to it as clubs in your bag. I mean, it's still the same sport. You're just learning different shots. So I started in what I considered to be a very rudimentary form of real estate investing, which was buying rental properties, cleaning them up, and renting them. It's very light work when it comes to the rehab. Might just be, repainting it and changing the flooring out. It was real straightforward, but there's still a lot to learn even at that stage of investing. You learn how to find tenants, you learn how to manage the property, how to manage the repairs. So once you feel like you can do most of those things in your sleep, then you can graduate to, more and more complex projects. And I think that's what I was trying to express when I said, do what you're, stick with what you're good at but at the same time, don't stop growing. If you see an opportunity and you think, I've done 70% of that already, that's probably a really good place for you to go, because there's 30% still to learn. But if you spend all your time as a landlord and then suddenly you decide to go open a restaurant, you may be stepping outside of your area of expertise and may need some additional resources there.
Yeah, and by additional resources, first thing that pops in my head is, can I join into this venture with somebody else who's already run through it a bunch of times so I can learn from them?
Exactly.
Yeah.
Exactly.
So don't go on your own for almost anything if it's your first deal.
Right.
Would you say? Okay.
Well, yeah, I would say that it depends on your personality. I worry more about losing other people's money. I care more about other people's money when I'm responsible for it than I do for my own. I can deal with...
What a nice guy.
I am. I'm a giver. I'm a giver.
What a nice guy over here.
I'm going to tell you where to send your money.
I'm going to take care of your money. Just put it with me. I like it more than my own.
Absolutely. No, but it's true. I mean, no one wants to. I mean, you can come up with your own personal rationalizations for losing your own money, and you can kind of put that to bed. But I feel that, losing someone else's tends to linger a little longer.
God, it stings.
The responsibility of that. So, I think that on the one hand, some of my initial forays into rental property, initially I had intended to buy 2 or 3 duplexes just on my own, extinguish what capacity I had and do my own thing. And then I ended up partnering with some people. Instead, I showed the numbers to some friends and family, and next thing you know, we had a fund put together and started buying for a group. And I think it was really good for me because it accelerated my learning curve. It really, because I was taking on, rather than buying 2 or 3 and just kind of walking, we bought a dozen, properties in a couple months. So it was fever. It felt like a very fast run in the beginning. So on the one hand, for me, it was good to have partners because it elevated the rate of growth and the kind of the intensity of the challenge. But very quickly, I also realized that I could have done it on my own. I think I was leaning a little bit onto the expertise of my fellow investors as well. I felt like by having them as partners
What's the motivation behind leaning on other people for their expertise? What's behind that, do you think? Because that's something we probably all go to, right? We don't know if we can do it or not.
Right.
So we want to do that. So what's behind that?
I think part of it is just I think it's creating a safety net a little bit.
What's wrong with that? For you just getting going, right? Prove out a little track record or something maybe?
There's nothing wrong with that at all. And I think that it's a great way to build networks, people making money together. Point. So it's been invaluable. But I think the other thing is that you also need to take chances on your own to step out there and be willing to wrap your arms around an opportunity and just say, I can handle this.
What's the downside risk if we don't step out on our own?
It's lost time and lost opportunity. And
is it much more difficult for you to rally people together behind a particular asset? Like you can move quicker, capture opportunities, otherwise would slip away? Or is it more personal too? Like if you're never out on your own, do you really believe that you're actually the one that's in control of creating what you want for your life? I'm seeing you're nodding right there, but like it's something for you. It sounds like it's something deeper. Like it's like, I know that I'm capable. Like I'm capable of doing it.
Right. I think that there's a lot of satisfaction from knowing that you could go it alone, but that you choose to do it with others.
Yeah.
You know, I think we want to know that we have that independence, that need to take it all on, but then there's also the team side of it. You know, when I look back at my history, like from sports, I was always kind of a soloist. You know, my sports were, you know, trail running and triathlons and, you know, all solo endeavors. So I think that's my reflex, is to want to do it all. So I think that's just my natural inclination, but I've realized a lot of rewards from partnering.
Yeah, there definitely is. There's definitely huge rewards in partnering, right? Especially when we're talking about leveraging other people's brains and experience into what's going on. There's definitely an uptick in like a learning curve there. But there's also something that from my experience with it as well, is that there's a certain freedom that comes from knowing that you can put a full deal together by yourself. Because when you're able to be self-sufficient, that's when you're actually truly free as an individual. Because then it's not saying that I ever have to have anybody, but I can make a choice about who do I want to do things with, which is very different than I have to have certain people. Like if you ever have this is something I think everybody can relate to, is that you can have the experience of like a salesperson that comes to you and they want you to buy a product. You're almost guaranteed that they're never going to sell it to you, right? But if they're highly engaged in the product itself, that this is a very cool product, but they're detached from whether you buy it or not, then there's a high sale there. And I think the difference between those two things fundamentally relates to saying, do I have to have somebody else do something for me? Or can I be in a pursuit that I know is worthy in and of itself and be successful in that? And I think that's where the freedom comes from. And that also makes you like a more, not only an internal sense of freedom and independence, but also probably even a more likable person. Like, how much do we like it when people like latch on to us about like, we need you to do this deal? Do you ever do deals with people that come to you and are like, hey, I need you to be in on this?
Right. Yes.
Or, yeah, you have to come do this with me. Yeah.
Right, of course.
Yeah. It's like, no, I don't know. Immediately when you come to me and be like, oh, I need you to come in here and do, I'm like, whoa, how, this is not right from the very beginning, you know?
Right.
It's like somebody saying that, like, I need you to come on a date with me. Be like, that does not sound like a good time if that's how we're starting things on what's going on, right?
No, but I agree. It's the knowledge of knowing that you can manage the business on your own. Gives you the freedom to choose what you do above and beyond that.
Yeah.
And it's much like having enough passive income to do what you want to do, and then anything you do above and beyond that is done for other reasons. It's not done to put food on the table. It's done, out of, passion or interest for the project itself or the people involved.
Yeah. Something, right?
Right.
I mean, I think we've all seen time and time again that it's like the ideas of financial freedom really just bring higher class problems, which is, what do I do with my life? At the end of the day, right?
Right.
So I think that's one of the pieces I want to go into. Do you think do you want to go and we can jump into actually some of the deal analysis?
Sure.
What do you think?
Sure.
So one of the things that this podcast is based on is going to be showing, here's where I saw opportunities that come up. Here's why I saw them, and I think other people didn't see them. And then, here's where, the insides of those types of deals, look like today, or where the opportunities would lie.
Sure. And what we originally talked about when we were putting this together was doing something along the lines of a best investment, or my favorite investment, something to that effect. This one also happens to be one of my first investments, how my wife and I both got started on our first property. When I think back on it, you think about, what made it so great? What allowed us to pull it off in such a way that was impressive? I think a lot of it was just out of necessity, in that we didn't have a lot of money. We were just getting started. We were really hungry. And so because of that, we were looking for all kinds of hacks to take this initial purchase as far as we could. So back in 2010, when we actually, my wife and I got married in December, and then in February or March of the next year, 3 months later, we'd been shopping for a duplex just because we wanted to move into a certain neighborhood. For those familiar with Austin, it was near Zilker Park, which is a very desirable area. But we did not want to go from $1,000 a month apartment rent to a $400,000 or $500,000 house that would be 3-4 times the payment. So we were trying to figure out, how can we move to the neighborhood we want to move to for about the same as what we're paying now in rent. while also having the opportunity for appreciation and paying down the loan. So the duplex seemed like a natural strategy because we could buy a duplex for about the same price as a house. So while our payment would be, $3,000 or $4,000 a month, we could rent out the other side for a couple, maybe $2,000, and then perhaps we could get close to what we were renting for. So we were looking for a couple months, and a foreclosure. This is back when there were foreclosures. It was actually a bank foreclosure. A duplex in a great pocket close to Zilker Park came up for sale. There were a couple things about it that made us a really good fit for the purchase, I would say. And this comes back to the idea of highest and best. I tell people if you're going to go purchase a property and if you're not the best buyer for it, especially in a competitive market, you're probably not going to get it. Or if you do, you're probably going to overpay for it. So you need to find alignment between the asset and between your goals.
What does that mean? I've never heard of that before. About trying to figure out if you're the best buyer for an asset.
Right.
Is that because you have the most ideas about how to use it?
Right. It just means that your intended use for the asset is optimized. So I'll give an example. So if there was a house, in downtown Austin surrounded by skyscrapers and you're looking to buy a house so your dog can run in the yard and, you can have your picket fence, I'm pretty certain you're not buying that house because some developer is going to come in and pay a number that is far, far greater than the value that you place on that asset. However, if you're the developer in that case, it's a perfect fit. What you do is what that asset is optimized for. So you are the right buyer for that property in that scenario. So in this particular scenario, my wife and I were very well aligned with the asset. We wanted the neighborhood. We wanted something that required some work. This one did. And in this particular instance, because it was a government foreclosure, they actually would not allow you to purchase it unless you agreed to live in it. So all investors were excluded from the purchase. So
all law-abiding investors.
Correct. Correct.
Yes. Excluded from the purchase.
That's
because
correct.
What is the enforcement mechanism behind knowing whether you live in the house or not?
That's true.
It might be a little
just
sketchy.
Mortgage fraud, but I'm certain you could hire
an attorney.
Do it. Thank you. Exactly. So I remember the house was actually listed, even given that it was a foreclosure and it was somewhat distressed in condition and that the market was very soft in 2010, it was still underpriced. They priced it at like $290,000, and based upon our estimates, it was worth $375 at least on that day. Today, it's worth far, far more, but on that day, it was worth probably $375. So we overpaid. We ended up offering $350,000, effectively $335,000. It was $350,000 with about $15,000 in closing costs. So about $44,000 more than asking. And as an agent, I have access to MLS. So I went back just for my own gratification and confirmed that is the most anyone had ever overpaid for a duplex in the history of the MLS in Austin, Texas, up to that point.
I'm jonesing to see how in the world you thought overpaying by $40,000 was a great idea.
Absolutely. So our mantra at the time was...
Because you're insane. Right. Everybody else would have told you you're absolutely insane.
And I was
to be
told
able to do that.
I had other agents calling me afterwards, kind of snickering about what we paid for it. And our mantra was, pigs get fat and hogs get slaughtered. And the way we rationalized it was, we were paying $335,000 for an asset worth $375,000, meaning we're getting $40,000 off of an asset. What's the point in bidding $310,000 if you don't win it? Because
you might be wrong about your highest and best use of the asset, right?
You could.
Because that would be it, right?
And 100% of nothing is still nothing. So.
Yeah. Well, I mean, that's like really the piece is saying that like you have to be a little bit cocky to be able to say, I see something here that other people aren't seeing. It's so much so that they're going to make fun of me because of it, right?
Absolutely.
That puts a dangerous position. I mean, like, I just can't understand, I can't emphasize that enough. I'm saying that, almost, if you're going to be at the high, if you want safe investments, everybody's going to agree with you. That's great. If you're really doing something different, everybody's going to think you're wrong.
Right. And some of our best investments have been properties that were significantly underpriced, and we blew everyone out of the water with our offer. We wrote an offer that we felt was significantly below market value, but ridiculously more than asking.
You got to tell me that how you're thinking differently about these deals, right? Because before we were talking about the exit strategy being our key piece of what's a worst case.
Sure.
But you're obviously doing something that's really, really different than other people.
Well, I think that here's where the breakdown occurs in most people's logic. Most people think that something is worth anchoring? They anchor the value of the asset based upon the asking price, which has nothing to do with anything. What someone offers to sell a property should have absolutely no bearing on what you pay for that property.
That is their understanding of the highest and best use of the asset value.
That is.
Which can be totally different than yours.
Correct.
So theirs should tell you nothing. If it's not your set of assumptions and your highest and best, then throw it out the window.
The only thing that number should tell you is what the probability is of you getting it.
It's a negotiation position at best, but it doesn't tell you anything about the asset.
No.
All right.
No.
I'm with you.
So we see plenty of properties that are horribly overpriced, and oftentimes we won't spend our time, we won't write an offer. We won't take the time because we know that our number is so far below what they're asking that it's probably a non-starter. So now if it sits on the market for a while and no one else jumps in, then we may revisit that. But when we see people that have dramatically underpriced an asset, we know if we move quickly and move to a reasonable number that's a value for us, that we can get it off the market before other people have an opportunity to realize what's happening.
Very nice. Yeah. Well, it's a beautiful thing. So you played into buying your first property with the duplex. You overpaid for it dramatically. The laughing stock
in
the town.
In the eyes, right.
of the town.
Absolutely.
And there's something that you saw in that property, which spitballing here is because you thought that the rents would be produced high enough? Like, is it a cash flow type of situation?
On that particular one, we were looking at sales comps. It was really hard to use rental multiples in that neighborhood because really nice neighborhoods tend to have pretty poor rental multiples. So we looked at recent sales comps and conditions, and we just felt like they had just missed the mark on their estimate of value. At the time, we just wanted a duplex. We wanted to live there. We didn't have a master plan. We just knew that we were going to have an inexpensive place to live and that rents would rise over time on the other side, and that it would hopefully cover the taxes, and we just have an inexpensive place to live, quite frankly.
Yeah.
But as time went on, we found a number of ways to profit off the property. And before I talk about that, I want to mention one more thing. So the way we wrote the offer was $350,000 with $14,000 worth of closing costs, which is all of our closing costs essentially, paid by the seller. And it was a FHA loan for 3.5% down payment. And as a real estate agent, I took a 3% commission at close. So we actually put 0.5% down on the home, which is $1,500 to buy a $350,000 duplex. So our cash out of pocket at closing was $1,500. So about as close as you can come to a true no money down deal, on the market.
And what was it that allowed you to negotiate that? I mean, the real estate agent piece I could get, and maybe I have like a friend that's like willing to take like half a point or just hook me up with doing it for me for free or something like that, right? But the other pieces of it, like what was it about that allowed you to negotiate that additional piece with the seller?
At the end of the day, the seller doesn't really care what they're paying in closing costs, or at least they shouldn't. They look at their net numbers. So if you're a seller of a property, there's really shouldn't be any difference between someone saying, I'll give you $335,000 right, with no closing costs, or I'll pay you $350 and you kick me $15,000 in closing costs. At the end of the day, they still get the $335. So for us, it was just creating a deal structure that worked for us and minimized our cash out of pocket so that we could, have additional funds to reinvest.
And you just had to get the financing company on board with flowing, right?
Yes. Okay. And we have a lender we'd worked with here. And I have to say, having a real estate license and being an active realtor does allow you to, pull some strings and get things done a little more efficiently and faster than you normally would be if you weren't. So we pulled that, we closed on it, we were thrilled to learn we won. Turned out we only won by about $7,000. So we did overpay by $7,000. There was over a dozen offers written. So we were thrilled to have it, and we rented the other side for more than we thought we would. I think our total payment was like $2,600, and we rented the unit next door for $1,500. So now we're living in our neighborhood of our choice for $1,100 a month, and we were pretty happy at that point until the big turn occurred for us on my 40th birthday, which was in Colorado. We actually rented a vacation rental and had a bunch of friends out. And on the way home from that weekend, my wife said, we could do that. She said, I opened all the closets in the house. She said, I looked at everything in the storage and how they had everything keyed. And she said, we could do that on our house. And
gotta love a nosy wife.
Yeah, she was
poking
around.
The business.
I'm out snowboarding, and she's working up the numbers. So by the time we got back to Austin, we had hatched a plan. It just so happened that my birthday is about 2 weeks before South by, which, as I mentioned, is a really big weekend for us. So we set a goal that within the next 2 weeks, we would have the house prepared, photographed, and rented for South by. And one of the hurdles we had to overcome was where we were going to live, because we were renting our unit that we lived in effectively. And so that's when we bought our first trailer that we pull behind the car. So we'd always talked about getting older and having a motorhome and in our retirement years and our golden years. So we kind of accelerated that process and bought one locally and figured if we hate it, we'll just turn around and we'll sell it. And we ended up booking for South by. It was maybe like a $4,000 booking, and we bought the trailer for like $10,000. So I figured we could sell it for $8,000 or $9,000, and we'd still be up. Yeah. Even if it was a terrible experience, like back to what you said, what's the worst that can happen?
Yeah.
We get a vacation for free, and we, make a couple grand, and then we never do it again.
Yeah. Well, that's like the upside of doing weird stuff, right?
Right.
Is that you get to figure out whether it works or not.
Right.
Like I don't ever realize this until I talk to some of my friends about all of the weird stuff that I do. And then, but it's always led to but everybody always sees is the end product, right? It's like who you are today, like what you have today, right?
Right.
But what they don't see is like all the iterations that happened in between where you were doing a bunch of funky stuff, trying to figure out like where are the opportunities at and taking stabs.
Absolutely.
And I think that's like the key piece of your story that I love about it is that it's just like, let's just get comfortable with trying some different stuff out and okay being wrong, right? Like we hear all these stories about it being like all the great pieces, and that's the part of what we're going to continue on today is with, talking more and delving more into like how does those deals actually work. And then, I can't wait until the future until we get to hear some of the stories about when they don't go so well.
Absolutely.
Right? Because those are also equally as important, right? Like we got to look at if you're only looking at what all the winners, then you never actually learned anything because everything just kind of turned out good, right?
Absolutely.
So where's next in those stories, Scott? Like so you guys end up doing some cool moves here with and you started, this is where you're dipping your toe into the short-term rentals, amazing amounts of cash able to generate in short amount of time. That's almost 3 months worth of rent of doing that?
Yeah.
From one vacation rental?
Yeah. So I'll just fast forward to, that was 2012 that, we bought the property in 11. 2012 was the first year that we started doing vacation rental on the unit that we lived in. And then the next year, the tenants next door decided to move out. So we thought, this has been going so well. Why don't we go ahead and convert the unit next door to a full-time vacation rental? Yeah. So we made that switch, and it went great. So by 2013, we were largely, I would say that was the first year that we were largely renting both units for vacation rental. So that year we ended up with about a little over $100,000 worth of revenue and about $60,000 worth of profit after expenses. And that includes all expenses on one asset. And that's been going on now for over 5 full years. So the wrap up to that asset the short version is we've seen about $60,000 a year in profits times 5 years, so about $300,000 in cash flows. We've seen about $500,000 in appreciation on the asset. So the asset that we bought for $350 is worth somewhere around $800 to $850 today. So total return on that $1,500 investment, and full disclosure, there was, we did reinvest some of those cash flows were reinvested into upgrades to the property, but those have been, netted out of the returns. So we're roughly $800,000 in return on a $1,500 investment in 5 years, which I had to put in a spreadsheet before I came down here, but I think it's about
so much math.
5,000% is the number. Something
less than that,
50.
it's barely worth my time.
I know. Why bother?
Hey,
so it does set quite a high bar for future
Yeah.
investments, there's no doubt. But that's one we're really proud of. And then, we created it together, and it was kind of the kickoff to some other vacation rentals that we've purchased and now operating in Austin. And now we're, here we are 8 years later. We're both, full-time real estate investors in Austin and loving it.
That's fantastic. I just want to go, to get into the nitty-gritty piece of what this deal is. There's a lot of figures and numbers that you're thinking about as you're looking at the deal. And those are things that probably you can Google a lot of that stuff online, right? To be able to say, what's a spreadsheet of how I should analyze this deal.
Sure.
But that's, in my mind, and I was just going to see if this lines up with you, is that's not where the magic happened. The magic actually happened in this front end piece of, I could see an opportunity where everybody else is acting underneath bad information, that we have insecurity about what is rental income going to look like, what's our multiplier going to be there, and then can able to look at that and say, there's actually some other criteria that I'm going to look at that's going to give me a better take on what that is and everybody else is looking at. And since I know the Austin area, just spitballing an idea to see if I'm on track here, because I really like being right. And guessing at stuff and being right about it is even better. Is you look at it and say okay, well, I actually know this is a really highly desirous area because I can probably look at what are the types of people that are trying to live out here and what do those mean incomes look like. So then you can know what is the affordability of it, right?
Sure.
And what other types of things are you looking at besides, just that to be able to tell you that you're going to guess better than everybody else?
Right. Well, obviously, I think the two big pieces that we did know on the front end, one was that we were buying a rental type asset. We weren't buying a house. We were buying an asset where we were going to, at the very least, we were going to buy an asset that minimized our out-of-pocket expenses. So I remember at the time, within months of us purchasing that duplex for $350,000, we had, friends who were buying, houses and condos and other such assets in the Austin area for similar prices. But they were doing it from a consumption standpoint. I hate to bring up the ant and the grasshopper, but we sacrificed. I don't have any photos with me, but it was a little bit like a haunted house when we bought it. It looked
fantastic.
It was green. It was this ugly green on the outside. It had like a Fannie Mae, they have this cream colored paint that they put on every house. I remember walking our friends through it and telling them, hey, look what we just paid $350,000 for, and the acting, the faces that they managed to keep, the way they managed to keep it. It's so nice. Happy for y'all.
This is great. You guys really made a good decision.
Good for y'all.
Yeah.
So I remember that, and I just kept thinking, we've always bought, rental type assets, and we like to buy things that are beat up. The reason, I love duplexes for a lot of reasons. One of the reasons is that, whenever you go into a neighborhood, you want to be the scourge of the neighborhood. Okay. You don't ever want the biggest house. You don't ever want the nicest house, because consequently everyone around you is pulling you down. The neighborhood is the average of the homes. And so you can either be lifted up or you can either be drugged down. So duplexes tend to be, at least in Austin, kind of sprinkled into some of the single family neighborhoods.
Okay.
So by buying a duplex in a small pocket of duplexes surrounded by houses, which is what this was, we were lifted up by the neighbors around us. So we knew that we had a lot of potential to go from one of the worst properties in the neighborhood to, kind of living up to the rest of the neighbors.
Yeah.
So
that gives you that extra added piece, right? Because you can see, what are bigger forces that are at play, like what's going on, right? I can know like what is the neighborhood going to be doing. I know that people are going to misvalue this because they don't understand what the incomes are here of what they can pay for rents.
Mm-hmm.
They're seeing something that's already ugly. They don't want to do the work to get into it, right? Like I think you'll see guys like Grant Cardone talk a lot about that. Like they'll ask the question whenever they go into it. They always see multiple properties, right? And they're trying to see multiple properties in the same type of asset class. And they're asking themselves, why is everybody else not wanting this asset, right? Because that goes back to your piece. Where did the assumptions they're making that are wrong or right about like what's going on here? And that's where the information comes in. Is that the assumptions everybody else was making is, I don't want to do the work into it. I don't know what the rents are. They're probably not that great because this house is ugly as hell.
Right.
And so, all right, I'm not going to really, I'll pay a little bit more than the asking, you know, but I'm not going to pay what my true value is, right? Because a bunch of people bid more, right?
Right.
You just happen to be the most.
Right.
So it's not like you were the only one that even saw the opportunity.
No. It took a lot of things came into play that allowed us to get it. But yeah, forced appreciation is a big component when we look at houses. We like to buy houses where we know that by putting a little money in, we can create equity quickly because that offsets a lot of other risk within the investment. So yeah.
It's a beautiful thing.
It was. Yeah.
Well, that's awesome, Scott. Is there anything else that we want to talk about with that asset or with that investment? Or about how you're using the rental incomes, or any insights that you have about like the deals that work with that?
Sure. Yeah, I could touch on a few things just with vacation rental, in general. I guess I would just say that, check your local regulations with respect to vacation rentals. It's a moving target in most cities. Austin has a number of regulations limiting the density of vacation rentals, so don't assume that you can do whatever you want with that property. The nice thing about this particular property and in the Austin regulations is they will allow you, for a property that's homesteaded, that you live in, and that's homesteaded, they will allow you to get a license. So it's kind of you get your first license, no problem. But when you start acquiring additional properties, there's right now a moratorium on licenses for any rentals less than 30 days. So you just need to know what you can and can't do within the laws of your locale on the vacation rental side of things. So go in kind of with your eyes wide open, find a real estate agent who's familiar with those rules and regulations, so you don't buy something that you can't, utilize for the reason that you purchased it. But we continue to put money back into our vacation rentals, constantly improving them. It's a great way it's like, instant gratification. You can put a few $1,000s into countertops, this weekend, you can photograph it, the next day, and you can upload those photos and instantly reap the rewards of additional bookings and higher rental rates. So we've really enjoyed it. And we are actually, partly as a result of the regulations from the city, we're starting to move more towards what I'll call a midterm rental. People call them corporate rentals, but there's short-term rental where people typically are doing nightly, maybe weekends or a week or two, and then more of a traditional long-term rental where people rent for a year at a time. We're starting to kind of hit that middle market, trying to go where there's a little less competition into kind of a fully furnished, 2, 3, 4, sometimes we even get 6-month rentals, and we do far better than we would on a year type rental, a year or longer, but we also end up with less regulation, less turnover, and less management than a short-term rental, like a weekend rental. So.
Well, it sounds like, I know that you do some fundraising that you do for a lot of the work that you'll do, and some fund management as well. Do you guys ever look to recruit or to train new investors? Is that something that people wanted to reach out to you, that you would be interested in, facilitating that conversation with how people should be using the real estate, or, potentially how can they get a hold of you to be able to put money with you if they want to?
Sure. Well, the easiest way to get a hold of me would be on my website, which is, www.realtystake.com, Realty, REALTY, stake, STAKE.com. I'm always willing to talk to people about, what their investment goals are and answer questions. And I've spent a lot of time investing in Austin, so that's really where my market expertise lies, but certainly I can add to the conversation in just about any market when it comes to things like the vacation rentals and whatnot. So, feel free to shoot me an email or drop me a call.
Yeah, and if you find something that Scott doesn't know and an asset, please let me know, because I haven't been able to find anything. This guy's been around the Austin market with all different types of asset classes and all different levels of investments. I personally know that he's fundamentally involved in many multi-million-dollar funds, so he's very humble with the type of expertise that he brings, but always try to connect either with him or somebody like him to help shortcut your way into learning about what's going to work for you in a strategy. Because just connecting with somebody that is a professional investor like Scott Sutherland or myself or CPAs that are also real estate investors are the fastest way to be able to learn what's going to work for your exact situation, because they've seen 10,000 scenarios. So they can quickly get down to say, here's the 3 that are going to work for you, right? In his case, it was this, how can I get into a property and then turn that into like rental income? And I don't have any money to be able to get into it. And if you came to him today, that would be something that he'd be like, all right, well, here's what options are actually like, because the landscape is always changing.
Yeah,
right?
And if I could add one more, I still believe that buying a duplex, if you're new to the game and you want to, you're looking to build wealth, you're looking to learn about real estate, I don't know of any better way to get started than buying a duplex and moving into it yourself. There's so many financing options for you. It's a great way to learn the game. You have one tenant only to manage, and they're right next door. That can be good and bad, but it's usually good. I can tell you that there's a lot of what ifs. It's what if the toilet gets stopped up, or what if, the next door neighbor doesn't drop his rent off and then I have to deal with this situation and talk to this person, or, but I can tell you that it's never as complicated or stressful as you might think. And that the best way to learn is to jump in with both feet and take the first step. And if you buy a good asset that you can make some improvements to in an area that's trending well, the risk is very low and you'll learn a ton and you'll probably do very well.
Yeah, I can't emphasize that enough with what you're talking about now, which is saying if you're buying something that's automatically going to cash flow and offset your own expenses, then it's almost like there's impossible to lose unless you're way overpaying, right, for what it's going to be. So, always be smart, of course, but the duplexes are a beautiful thing. Don't start with a transmission and auto repair shop that has the walls falling down like I did.
Speaking from personal experience.
That's a very, very painful way of stacking cinder blocks on the weekends while you're reading through torts. So thanks, Scott, for today coming in, and this was fantastic. I hope everybody learned something. I know I did, especially about that. The way you're thinking about deals, I think is really cool, because that's a really piece that I don't think we talk a lot about numbers, but we don't really speak a lot about what's really going on with us as individuals behind it. And to me, that's a piece to say, okay, it's cool to geek out on what the actual numbers are like, but we really actually need to understand what's going on with us as people.
Where your motivation is. And hopefully there's other people out there who are coming from a kind of a similar mindset and can connect with, those challenges that we fought our way through and think wow, I think that same way, or I have those same concerns, and, it's just a matter of getting out there and, taking a chance on something.
Absolutely, yeah. And that's what we're all about here on this podcast, is really about trying to say, do these stories make sense to you? Is the way that we're thinking about deals something that makes sense to you as a listener into it? And if you do, then these are the lessons that we've learned from ourselves as professionals and advising tons of other people. And so you can see from our insights of, hundreds of thousands of times, even though this is your first time, the story is the same. How do you feel, and what is that going through? And, what are the challenges, right?
Yeah, absolutely. I heard someone say that, people tend to overestimate what they can accomplish in a year and underestimate what they can accomplish in 5. And that really feels true after kind of our journey through the real estate investing world. It's been 8 years since we really jumped in with earnest, but I think back to our start. I remember days where we were so hungry to make it work and so just determined. I remember times even, where we would get a booking request and they would say, we want to check in 3 hours. And this was the house that we were actually living in. And we would throw everything into the closets and lock it all up and clean the house ourselves and get out the door, now we've got, we have people taking care of all that stuff and doing all the prep, and it's all, at a much higher level. But But it makes me realize just how far we've come in effectively a short period of time, what seems like quite a short time.
Yeah, I think that's awesome. And I want to also emphasize the fact that people is like that if you read books like The Lean Startup or anybody that's in the startup world, it's those types of actions. It's not because you would choose to live that way. It's because that the speed you want to move requires you to do stuff that is, we're just going to make it work. And then so that way we can figure it out as we go along. And in the startup community, they talk about that as being like iterations of a product or what is your speed to market with whatever you're creating. So really, from my perspective as an entrepreneur, is when I look and hear that story, what I'm really saying is like, oh, this is actually an insight of what happens if you have a startup mentality to say, we're going to test a bunch of things. We're going to find out which ones that work. Boom. Now we put all the energy and capital into it. And that's where we have massive growth as an investor, instead of saying, okay, well, we're just going to do these really, I'm just going to buy a house that I can put a piece of paint on. No, right. Okay. Well, if you're going to do that, you're going to really cap what your growth is, right? Right. If you really want to grow, you got to be willing to have things be a little right. messy and do a little bit of stuff that's uncomfortable.
Well, and back to the 70-30, every time we had an opportunity come before us where we felt like we knew how to do 70% of it, we took it. Even if it wasn't, quote, in the plan, it wasn't the type of investment that we were intending to pursue. If it was something we hadn't done before, but we felt like we knew enough about it that we could pull it off, we did it. And we did it because we wanted to figure out if we'd like to do it, and we knew we'd learn something. And I think that's paid a lot of dividends because, all those skills, one day you'll find yourself standing where this opportunity comes up and you think, wow, I already know how to do most of that or all of that. And if you don't jump out there and learn new things and go after new opportunities, then you'll never have those skills when the day comes, when that opportunity arrives.
Yeah. And I just want to recap and end on that note, which is to know what your ultimate realistic downside risks are. And if you can afford them, then take the risk. Learn what the new skill is going to be. And it might not be something that necessarily you're going to use today or even tomorrow, but now you have that extra club. And when it's ready to be able to do it, you'll see the opportunities that other people aren't seeing because you'll have the experiences that they don't have. And that's where you're making the big bucks, right? I love it. Thanks, Scott, for coming in today. I hope just remind everybody the name of your website just in case they want to get in hold of you.
Sure. It's www.realtystake.com, REALTYSTAKE.
Yeah, and one of these days I'm going to make you get and start up a fund management with me over here, so we're going to get that going. Thank you for coming in, and we'll see you again soon.
All right, great, thanks.
That's all for this Best Deal episode, and I'm your host, Scott Royal Smith, with the Real Estate Nerds Podcast. When investments go good, they can go great. Your legendary best deal could be your next one, so keep at it. Thank you for joining us, and if you enjoyed the show, leave a review to help clue in those sleeping masses for what they need to know and what we all need reminders of. Do your good deed for the day, and I'll see you again soon.